Welcome to Nolan Financial Radio. I'm Chris McKinney coming to you from Nolan Financial Partners here in Colorado Springs. Great to have you with us today. I want to start today's show with a question that sounds simple, but most people have never actually sat down and answered it directly. Where should your safe money live? Not your growth money, not your speculative money, your safe money. The portion of your retirement savings that's not supposed to go down. The money you're counting on. Where does it go? Most people, when they answer that question, end up in one of three places. Some keep it in the stock market, usually an diversified mix of funds, maybe tilted more conservative as they get close to retirement, or maybe they put some of it in bonds, treasury bonds, bond funds, maybe a mix of corporate and government fixed income. Maybe they use mutual funds with bonds. And some put it in annuities, insurance contracts that offer guaranteed rates or index-linked growth with principal protection. Each of those is a real answer. Each has legitimate arguments behind it, but each also has real trade-offs that do not always get the same amount of airtime as the pitch. So today we're going to talk about all three of these, quite honestly, side by side with current numbers, because comparison looks very different in 2026 than it did even just 5 years ago, right? So most people's assumptions about these options have not caught up with the data, what the data actually shows. So here's why this matters right now. We are sitting in an unusual moment. Interest rates are higher than they have been in over a decade. That changed what bonds pay. It also changed what annuities pay. And the stock market, well, it has done what the stock market always does. It goes up, goes down, and keeps everybody guessing. So you have been operating on autopilot, money in the same place. It has always been same allocation you set up years ago. Today might be the day that changes, because there is a very real possibility that a different approach would serve you better than what you are currently doing. Let's get into it. Hey, if that question, where should my safe money live, has been unanswered in the back of your mind, it's time to get a real answer. At Nolan Financial Partners, we help people like you sort through exactly those decisions. What goes in the market, what goes in bonds, or whether an annuity might belong in your plan. Your first consultation is completely free, no pressure, just clarity. Call 719-210-4242 to schedule your complimentary appointment today. That's 719-210-4242. Check out our website, nolanfinancialpartners.com. Okay, back to the show. I'm Chris McKinney again. Let's start with the most familiar option, the stock market. For most working Americans, the stock market is where retirement savings live. A 401k invested in a mix of equity funds, an IRA holding index funds, maybe some individual stocks. This is the vehicle that has built enormous wealth for millions of people over the past several decades, and for good reason. Over any long rolling period, equities have historically outperformed virtually every other asset class. That is the argument for staying in the market, long-term growth potential. And it's a real argument. Nobody seriously disputes it. But here's what the argument misses when we apply it to safe money, to retirement money. It's a portion of your savings that you can't afford to lose. The market does not care about your timeline. It doesn't matter. It doesn't think about where you are in your retirement and how you're having to spend your money. If you are 5 years from retirement and the market drops 30%, which it has done multiple times in the modern financial history, you don't have 30 years to wait for a recovery. You might have 5 years or 3, or you might retire right into the downturn, which is what a lot of people did in the early 2000s, right? Which is what researchers call sequence of returns risk. So what is the most serious threat in retirement planning? And it is almost never talked about in the same breath as market returns. The volatility problem. So go banking rates. So you can check it out. Bankingrates.com. They wrote this year. They said if you want higher long-term returns, stocks and ETFs are your instruments. If you want guaranteed monthly income and protection against loss, that is a different conversation entirely. The stock market was not built to be a safety net. It was built to grow wealth over time for people who can absorb volatility. So what this is trying to get at is the meaningful distinction for someone who is 60, 62, 65 years old and watching their portfolio, because the emotional and financial cost of a major drawdown at that stage of life is not just a number on a screen. It is potentially a permanent reduction in what you can live on. So let's get to taxes. So the tax consideration that works in the market's favor, one worth acknowledging: long-term capital gains in taxable accounts are taxed at preferential rates, right? 0, 15, or 20%, depending on your income. So that is a meaningful advantage over ordinary income rates, which is how withdrawals from most retirement vehicles, including annuities, are taxed. So the stock market has real advantages: growth potential, liquidity, and a favorable tax treatment on gains held long term. The question is whether these advantages are the right match for the role you need your safe money to play. So what the market is not: it is not predictable. It is not smooth. And for money you generally can't afford to lose in the wrong year, the risk profile of equities have simply not fit into the job description. That does not mean pull everything out, okay? It means intentional thoughts, intentional planning about how your market exposure belongs in your portfolio so that it is playing defense for you, right? And you have a way of playing defense. So let's look at the option that most people use as if it's a play: bonds. So I want to spend a little time on this segment because most financial ratios would, because bonds and bond funds are widely understood. And that misunderstanding has cost a lot of people real money over the past several years. Here's the common belief: bonds are safe, they are stable. You buy them when you want to protect your money. The stocks are the offensive portfolio, bonds are the defense. It is partially true, but it is way incomplete. Okay. First, let me draw a line that most people never hear exactly explained clearly. There's a significant difference between owning an individual bond and owning a bond fund. When you buy an individual bond, say a treasury note or a corporate bond with a 5-year maturity, you know exactly what you're getting. You lend money to the issuer. They pay you interest on a schedule. At the end of the term, they return your principal. As long as the issuer does not default, your principal's safe. That is predictable. That is stable. A bond fund is a completely different animal. A bond fund holds pools of bonds and is priced daily in the open market, just like a stock. And here's the thing that surprises a lot of investors: when interest rates go up, bond prices go down. They move in opposite directions. That's not theory, it's just math. So if you're in a bond fund and interest rates rise, which is exactly what happened in 2022, the value of your bond funds drops meaningfully. The Bloomberg U.S. Aggregate Bond Index, which was a total bond market funds type of index, it lost over 13% in 2022. That is not a stable, safe outcome. That is a loss most people did not expect from what they thought was their defensive position. So there's another issue with bonds that does not get enough attention: reinvestment risk. So a website called Annuity.org explains it this way: as bonds in your portfolio mature, their proceeds need to be reinvested. In a rising rate environment, that works in your favor. you're rolling into higher yields. But if rates fall, you are investing at lower rates and your income decreases. You do not know today what rates will be in 3 or 5 years when your bonds come due. A fixed annuity locks in your rate for an entire term. You know exactly what you're earning from day one to the end of the contract. That certainly has real value, right? So, particularly for someone who needs predictability in their income or savings plans. So, here's what the current environment gets interesting and where a lot of people's assumptions are out of date. Annuity Journal and research published in early 2026 compared annuity rates to comparable maturity treasury yields and found a meaningful rate advantage for MIGAs, multi-year guaranteed annuities. These are fixed annuities that function similarly to CDs. You lock in a guaranteed rate for a set term, typically 2 to 10 years. The money grows tax deferred, and the rates as of mid 2026 are competitive with or better than comparable treasury yields, with the added benefit that you do not owe annual taxes on the interest while it accumulates. As of June 2026, myannuitystore.com is showing top MIGA rates at 6.5% for a 7-year term and 6.3 for a 5-year term from A-rated carriers. A 5-year treasury note, for comparison, is running in the mid to upper 4% range. That is a meaningful spread, and the tax deferred advantage on top of it makes the effective comparison even more favorable for the annuity. So now I want to be balanced here because bonds do have genuine advantages that annuities can't match. Liquidity. You can sell a bond or exit a bond fund any business day. An annuity has surrender periods, typically 3 to 10 years, during which withdrawing more than the small percentage of balance triggers a fee. If flexibility is important to you, you might need access to that money. Bonds win that comparison. So Annuity Journal's 2026 analysis summed it up in this way. Bonds provide market-linked fixed income with liquidity. Annuities provide insurance-backed guaranteed growth with tax deferral. They are not direct substitutes. They solve different problems. The question is, which problem are you actually trying to solve? So let me say that again, because it's the most important thing that I will say in this segment. Annuities and bonds solve different problems. If you need liquidity, look at some bonds. If you need a guaranteed rate for a defined period with a tax deferred accumulation and no annual 1099 on the interest, a MIGA or a fixed annuity, a fixed index annuity deserve a serious look. Okay, you just heard something that surprises a lot of people. Bond funds can lose money. And some annuities are currently out yielding treasuries with tax deferral advantage on top. If your safe money is sitting somewhere that's not actually that safe or not earning what it could be earning, that conversation needs to happen. Call Nolan Financial Partners. We will look at your money and tell you honestly whether it is working as hard as it should be. Call 719-210-4242. Your complimentary consultation is waiting. Call 719-210-4242. Check out our website, nolanfinancialpartners.com. So welcome back to Nolan Financial Radio. I'm Chris McKinney. Now let's talk about annuities as a direct alternative to bonds and market-based accounts, what they do well in that role and what they do not, and how to think about the fit. So the MIGA is a bond alternative. The simplest and most direct comparison is the multi-year guaranteed annuity, MIGA, versus a treasury bond or CD ladder. So you probably heard of CD ladders, right? So if you're using bonds primarily as a stable interest earning vehicle with no intention of trading them, the MIGA deserves to be in that same conversation. Excuse me. So here is what you get with a MIGA: a guaranteed fixed interest rate for the full term, principal protection and tax-deferred growth. You do not get a 1099 on the interest each year like you do with a CD or treasury. The tax is deferred until withdrawal, which, if you are strategic about when and how you take the money, can meaningfully improve your after-tax return. Andrew Rosen, president of investment management firm Diversified LLC, made a point that I think captures this well. He told annuity.org that a fixed annuity is, quote, much more of a fixed, predictable product, whereas your general investment world, stocks, bonds, mutual funds, ETFs, go up and down and are not predictable. The contrast is the core of the argument. For the safe money bucket, predictability has value. Okay. And so some people that are getting into retirement and they're moving into their mid 70s, they really start thinking more and more about these type of alternative safe money places like multi-year guaranteed annuities or fixed index annuities, fixed annuities, because they don't need more money than they have to take care of them. They just need to not lose it. And so that's one of the biggest things that we've had with a number of our clients. We've got one of our clients we've had for the longest time. She does not like the stock market. So she said, "Hey, I do not like the stock market. Where can my money live and still grow? And then I have access to it." And so we put her money into some annuities, different kinds of annuities, different maturity periods. And she has had more money than she thought she would have in retirement. And she's had the money that she needed to do everything. And she actually, is that money hasn't gone down that much as far as the capital, because it's been growing kind of nicely, and basically she's been living off the growth. And so she still has all the money she started with. So it's using an annuity. There's a whole range, whether it's 10% or 30% or all of your assets. It's something that you would, we don't recommend you put all your money into an annuity, but for some people that may be a better feeling that they can sleep every night. They know that they're not going to lose money in the market. So there's another thing here that kind of comes into play is how well do you sleep at night, right? So the fixed index annuity is a market alternative. So we really haven't gone over the fixed indexed annuities yet. Now, maybe you're not quite ready to step out of growth. So, but you don't want to lose sleep over that market exposure. So that's kind of what I was talking about with this client. There's a thing called a fixed index annuity. So an FIA ties your returns to the performance of a market index like the S&P 500, but has a floor of 0. 0 is your hero when it comes to your retirement money. So in a year when the market gains, you get credited a portion of that gain, maybe up to a cap or some kind of participation rate set by the company. So if participation rate is 50% and the market goes up 20%, you get 10. That's kind of how that works. If the market goes up 20% and you have a cap of 10, you get 10. So it's pretty simple to figure out. And then but the best years are the years when you get 0, because when the market falls and destroys people's life savings, you had 0. So if we look at 2008, 37% drop in 1 year, guess what? People in this fixed index annuity returned 0. Zeros would beat the market by 37%. So that floor is the product's defining feature. So someone who watched their account drop 15 or 20%, say in 2022, like the 2008, they come to me and say, I can't do that again. I can't let all my money just fall away. So especially when you're pulling from that money to support your retirement. And so the fixed index annuity offers a way to stay connected to market growth without accepting the downside. The trade-off is pretty straightforward. You give up the full upside in exchange for the floor. In a year where the S&P 500 returns 25%, your credit may be that 8 or 10% with the cap, depending on what you have or the participation rate, whatever you have, but you don't get the full run. So that's how the company can offer these. That's where they make their money. But you also, didn't lose anything in those down years. So that money is playing a big defensive role. It's a trade-off. Many people in retirement or near retirement are comfortable making that, right? So I want to spend a minute on the tax angle. It is one of the most unappreciated parts of the annuity versus bond comparison, and it actually affects real dollars. So if you hold a bond fund or a treasury in a taxable account, you owe ordinary income tax on the interest each year, whether you spend that money or not. The IRS sends you a 1099 and you pay it. Now, if you're in the 22% bracket, you lose 22 cents of every invested dollar to those taxes, or the interest, right? It's just the interest. Every 22 cents on every interest dollar, right? To those taxes annually. So this reduces the effective compounding rate of your money. So inside a non-qualified annuity, one purchased outside an IRA after tax dollars, the interest compounds without annual taxation. You pay tax on the gains when you withdraw them. That deferral effect, compounded over 5, 7, or 10 years, can produce a meaningful higher after-tax balance than a bond investment earning the same nominal rate. Annuity Journal's analysis in 2026 identified this as a significant factor in the net advantage of MYGAs over comparable term treasuries for investors, in meaningful tax brackets. So, where do annuities belong? Where do they do not belong? So, where do they not belong? So, now I mean this. Let me just clear about when annuities they're just the wrong answer. So, if you need access to this money in the next 2 or 3 years, do not put it in an annuity. The surrender period means early access costs you. Keep that money liquid in a high yield savings account, a short-term CD, or a money market fund. Now, there is some liquidity in annuities, and it's usually stated by the contract. It's often somewhere between 5 and 10%. And so there is some access depending on the type of annuity. So not all annuities have this free withdrawal amount, but we like to get those type of contracts so that you do have access to a portion of the money. And often for some people, that's all they need. So if the it's got to be outside of a traditional IRA or 401k. So adding an annuity inside that account does not give you additional tax deferral, right? So if it's inside already a qualified plan, IRA, 401k, Roth, whatever, you already have that from the account wrapper. So in that case, you're paying annuity costs for a benefit you're not receiving. So that is a common sales mistake that costs a lot of people real money. Now, that does not mean we don't move some funds that are in IRAs or 401ks into annuity, because that's where their money sits. And so we move it in there for them, and so that they get the benefits of the floor and the fixed index part of the annuity as an alternative to the market. It's not like you have to actually pay for that tax deferral. The tax deferral is just the deal the IRS has with the companies that sell annuities. So it's just part of the contract there. So it's not that big a deal. So if your whole retirement plan is sitting in a single annuity product with high fees and complex riders you don't understand, then you may have gotten too much of a good thing. Annuities work best as a component of a diversified retirement strategy, not as the entire strategy. And we here at Nolan Financial Partners are very skeptical of adding fees to annuities or adding complex riders that you can't that are difficult to understand, and how your money is going to come out and those kind of things. We like everything to be straightforward, easy to understand. But if you've got an annuity that you don't understand, maybe it's an annuity that's a variable annuity, and it's in the market, so you've lost that floor. That's something to come see me about, because it may be time for you to get out of that variable annuity. Variable annuities can be a really powerful tool, but if they're not set up correctly, the contracts are bad. You want to really think about those, because the way they have the fees structured can really hurt those variable annuities. Now, I've seen some variable annuities that are great. I've seen some that aren't so great. So the framing I use with clients when we talk about annuities is kind of like this. We think in buckets. One bucket handles your near-term needs and stays liquid. One bucket grows over time. That may include market exposure. One bucket earns a guaranteed predictable rate with protection from loss. The annuity belongs in that third bucket. It's not competing with your growth investments. It's filling a role that stocks and bonds are not actually designed to fill as reliably. So the bucket strategy that I'm describing here, liquid money, growth money, protected, safe money, is the foundation of how we build retirement income plans at Nolan Financial Partners. We will show you exactly how your current accounts map to those buckets, where the gaps are, and what options make sense for your situation. No cost, no obligation, just a real plan. Call 719-210-4242 to set up that complimentary consultation. Visit us, nolanfinancialpartners.com, to check us out. But give us a call to set up that consultation, 719-210-4242. We covered a lot of ground today, so I'm glad you joined us today. If you have any questions about what I talked about here today, please give us a call. No cost, no pressure, no obligation. Your retirement's worth a second look. Let's take a look at it together.